Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, getting you ready to invest this week, the news you need to know, the stocks I'm watching, and very important week this week. Just hit new lows in the S&P 500 in the stock market last week, down to 3,500, down 27% since that peak in January. And I keep hearing market pundits, experts on TV, right, say that stocks are cheap and that investors should jump in all the way and buy back into the dip. Now, we talked about last week why buy the dip is broken this year and what to do instead, my strategy for investing in stocks. This week, we need to dispel another myth, though. I'm going to be walking you through the data and the evidence that says stocks are definitely not cheap here, and this is not a buying opportunity just yet, but the bigger picture is that this bear market just is not over, okay? Despite Thursday's heroic rebound that we all saw up 5% from the lows on that day, all the factors driving stocks lower are still getting worse, okay? Inflation is not going away. The jobs picture is still so strong that it's not letting inflation go down, and interest rates are still going up. Those will continue to hit on stocks. We're about to get a hit to consumer spending here over the next 3 months, and that's going to drive stocks lower. Stick around after that, though, and we'll do our Monday market update, all the news to watch this week, the stocks I'm following, and how to invest. Before that, big announcement, we have launched the Bowtie Nation. It's an official index, ticker BOWT. It's using the Index One provider, and in our partnership with StockCard, we've launched this Bowtie Index. This is a registered index to track the best stocks in the market and could actually become an exchange-traded fund, an ETF someday, so very excited about that. Now, what this is doing, this index is going to track the 500 largest companies in the United States, so that broad stock market average. But then it's going to use a unique process of qualitative and quantitative analysis that I designed to select the top 10% of the stocks within that sector or within each sector. So we're going to get the sector returns in the market, but then add to it extra returns from picking stocks. Strategy, again, is going to enable the index to track the market by sector, but then with that potential outperformance by finding the best of the breed stocks. Okay, nobody else is using this, and I'm excited. Back-tested results you see here over the past 5 years, the index would have done 99% against the SPY, that broad stock market ETF. The SPY 43% in red here. So back-tested results are very promising. And if you go to StockCard, I'm going to leave a link in the description below. You got to go to StockCard, and you'll find all this information on it. You'll find exactly how I'm picking the stocks in here, these quantitative factors that we'll talk through in a video this week. We've got, sales growth, operational margin, PEG ratio, 1 year operating margin here, along with the qualitative factors as well that I'll do in another video. So you're going to see exactly how I'm picking these stocks. You're going to get some great polls here that get your opinion on stuff, and then you're going to see exactly what is in this index right now. Now, like all indexes and products like that, I'm going to be changing up the stocks in the index from time to time. I'm going to rebalance twice a year, finding new stocks for the index and maybe dropping some out that don't meet the criteria. So you want to be on top of this. You want to follow this. So make sure you click on this little bell here, follow this index so you get advance notice whenever I buy or sell and add to the index. So go to StockCard with the link I'll leave in the description below. Click on follow there. You can go to StockCard and go to the Idea Center and Indexes, and you'll find the Bowtie Index. Again, that's ticker BOWT, and you can follow it to get advance notice anytime I add or take stocks out of that index. Now, I do want to talk about our main topic today because, after a 25% drop in the broad market, it can be easy to buy into that idea that stocks are cheap, okay, and that investors should buy into that dip now. The problem is, and why it's going to end up losing investors a lot of money is because the main measure analysts are using is just going to change. It's going to make stocks look a lot less cheap than they appear, and stocks are still going to continue to fall. Okay, what we're talking about here is the price to earnings ratio, okay, the PE ratio that a lot of analysts, a lot of market pundits and so-called experts on TV are using to say that stocks are now cheap. And if you look at that, the price of the stock or of the index, okay, what they're talking about is the price PE ratio of the S&P 500 as a whole, okay, the PE ratio of the S&P. The price is 3,600 right now, okay, it's the price of that index divided by the earnings or the aggregate earnings of all the companies in that index. And what they're talking about here is the S&P 500 is right at about 3,600 right now over the weekend. Earnings for the 500 companies within that have added up to about $210 over the last year. So if you do take 3,600 divided by $210, you get about 17 times. Now stocks get even cheaper though if you look at forward earnings. Okay, this is the S&P 500 forward earnings, and what this is this is taking what Wall Street analysts believe S&P companies will report in earnings over the next 12 months. Okay, and we can actually look at what that is. This is all in FactSet, by the way. Great free research there online. You just go to Google search and type in FactSet Earnings Insight. It's going to bring up each week's edition here. And if you look here, this shows the earnings per share estimates by Wall Street analysts. You see, the S&P 500 companies are expected to make about $223 this year in earnings. And that's expected to grow about 7.5% to $240 in earnings over 2023. Okay, that's this last line here. That is the total 500 companies in the S&P 500, that stock market index, what they're expected altogether to make in earnings per share, $240 next year. So if you take that number, if you take 3,600 and you divide by that number, that $240, stocks look even cheaper, right? Stocks now look like they've reached that 15 times price to earnings ratio on that. Okay, because if you take 3,600 here divided by the $240 in expected earnings next year, you get 15 times. Now, 15 has always been a great point to buy stocks. It's been where stocks were historically cheap at. You can see here they've made it. The 5-year average was about 18.5. They even made it up to as far as 22 times on a forward basis here over the last couple of years. So getting stocks at a 15 times multiple would be a great opportunity. There is a big problem here, folks, a problem that is going to cost a lot of investors a lot of money. That earnings expectations of $240 next year, again, would be about 7.5% growth from this year. Now, if we look at research by Deloitte, shows that earnings usually fall about 10% in a recession. So if we get a recession, earnings fall from one year to the next. So basically, the market is still saying that we don't get a recession and that earnings are going to grow. Okay, because again, the recession by definition is a slowdown in economic growth, slowdown in consumer spending, slowdown in corporate earnings, things like that. Earnings just are going to go down in a recession, and the analysts are just saying with that $240 price target or earnings target that we're not going to get a recession. And there is no way that happens, right? With interest rates continuing to climb, cracks are already forming in the economy, and all of those interest rate hikes by the Fed haven't been showing in the economy. Okay, it usually takes about 6 months. Research shows that for when the Fed increases its interest rates, the worst of those effects appear after about 6 months after they've stopped increasing interest rates, right? So instead of this $240 per share in earnings for the S&P 500 next year, we are going to get much less than that. Okay, if you just do some back of the envelope math, just some really easy math here, if we're expecting $223 in earnings this year, if you even take a 5%, a very mild recession that knocks off 5% off of earnings, that would bring us to about $210 per share in earnings next year. Okay. And now at this point, if you do that math, if you do that PE ratio, so the price of the S&P 500 divided by the earnings, if you do that divided by 210, so 3,600 divided by 210, you get a PE ratio of 17, not 15, but 17. And that changes the picture dramatically for how cheap stocks actually look. If you go back here to the forward 12-month PE ratio, again, this shows that it's 15 right now because they're using that old data. They're using the incorrect data on earnings, that E part of the ratio. They're using that. And it says it's 15, but it is actually more like 17, which, isn't expensive. Stocks aren't nearly expensive as they were just a couple of years ago, but they're definitely not cheap yet and not a buying opportunity. Now, I've shared my strategy for how I'm investing in all this a couple of weeks ago in our live stream. I am waiting for the stock market to fall a little bit further to put more cash to work. I did put some cash to work on Thursday when it hit 3,500. That was my first target there. When it hits 3,250 and then 3,000, that's when I'll put the rest of my cash to work. Not saying that it's going to get all the way down to 3,000 or even less than that, but the stock market will continue to fall, folks. There is just no avoiding, the higher rates, the high inflation, and the weakening jobs picture that we're going to see over the next 6 months. So be ready for that. Don't believe these old rules and the experts on TV that says stocks are cheap just yet, because